Hi, my name is Jesse Blocher, and this is my presentation of two-sided markets in asset management, exchange-traded funds, and securities lending. This is joint work with Bob Whaley. So our main point is that ETFs are not simply low-cost mutual funds. If you take away one thing from this presentation, I hope you take that away. First, we want to note that exchange-traded funds matter, right? That their AUM now exceeds that of hedge funds. Now that includes all ETFs. We're going to be looking primarily at a subset of physically replicated US ETFs today, but ETFs as a asset class are very, very important. Now, most ETFs are seen as passive investments and low-cost investments, but interestingly, they seem to be more profitable than mutual funds. So these mutual funds that are higher cost, that have higher expense ratios, somehow are making less money than ETFs, who are supposedly low-cost investments. Okay, and that's coming from, it's not just this news report, it's a Deutsche Bank McKinsey study that was done back in 2011. Now, our main point is that we can reconcile that seeming conflict by noting that ETFs are really operating on a different business model. They're not operating on a standard principal agent model that most mutual funds and even hedge funds, though we're not going to talk about them very much today. Those funds operate on a principal agent model where you have fee for service. You have you as the investor are the principal, and you invest your money with an agent who's going to invest it on your behalf. That would be the portfolio manager, either of the mutual fund or of the hedge fund. And yet what we see in ETFs is that revenues from securities lending, not investing, are sufficient to make ETFs profitable. And that the cost of investing in ETFs could come all the way down to zero. In fact, not only could it be zero, but Vanguard is saying they could even pay clients to invest in their products. Sort of a negative expense ratio here, which totally turns the principal agent idea on its head, because typically principals pay agents, not vice versa. So if that's the case, clearly there's something else going on. And what we propose is that ETFs are using a two-sided market model. Okay, this is an innovative model that's relatively new, but it is. We're arguing that ETFs are really the first asset manager or financial product to use this model, though it's very popular in other areas. So this model was kind of jointly put forward by Rocher and Tirole, who are two economists, probably very well known. Jean Tirole won the Nobel Prize recently, and Parker and Van Alstyne are in information technology operations and have done some work particularly with technology firms. Now, Rocher and Tirole's 2006 paper was very important. It's in the Rand Journal of Economics, and it does a really good job of really solidifying the analysis of two-sided market models. Prior to this paper, two-sided markets were kind of a you know them when you see them type thing, and were not treated very rigorously in terms of defining them, and Rocher and Tirole in 2006 did just that. Now, to explain more of what a two-sided market model, I'm going to give two kind of canonical classic examples. One is credit cards, and the other is video game consoles. So credit cards, we're talking about Visa, MasterCard, Amex. Credit cards are a two-sided market. So imagine that imagine credit cards don't exist, and you are an investor, or not an investor, a consumer, and you want to buy something at the local shop. Now, obviously, you can always use cash, and the local shop will always accept cash. But it could be, and we see this a lot in businesses in particular, that you would prefer to use credit to buy something, particularly, say, for more expensive purchases, durable goods. And we saw this a little bit in the pre-credit card day where Sears, for instance, issued a Sears card that could only be used at Sears. We don't see it much anymore. Why is that? So the reason why that is that credit cards created a standardized platform that investors could come to and businesses could accept, where they would agree upon this standard, or they would agree upon this one mechanism, being Visa or MasterCard or American Express, that consumers would use it en masse and businesses would use it en masse. But that was done because of the hard work of those credit card companies to create incentives or other attractive fee pricing to deliver a product that was valuable to both sides of the market. They needed to create a value proposition for merchants and vendors, and a value proposition for investors to use the card. And the way they do that is by using fees on both sides that can be positive or negative. So the equilibrium for credit cards now, and this is all in an economic framework with supply and demand and market power, etc. But the equilibrium in credit cards now is that we as consumers typically receive what I would refer to as a negative fee to use credit cards. And what I mean by that is that we typically, through rewards programs, end up netting more money in profit or in benefit than we pay in fees. Even cards that have annual fees on them, usually say you're paying $50 in an annual fee, you could make $300 or $400 in a year in terms of rewards on that card, whether that's through airline miles or other things like that. And some of these cards don't even have annual fees. You just have miles programs or rebate programs or something like that. So those are examples of negative fees. And that's the way credit card companies get you to use their card. And they want as many consumers as possible to use their card because their value proposition, turning around to merchants and such, is that, hey, look at all these people we have using this card, you should accept it. And then the merchants do. The other part of that equilibrium is that the credit card companies charge the merchants a so-called interchange fee. So for every transaction, I think for MasterCard and Visa, the rate is 2.75%. For Amex, it's a bit higher. I think it's like 3.5%. I think Discover's lower, maybe 1.5 or something like that. I actually don't know Discover's fee. But each of these cards have different interchange fees. And so the credit cards get a small percentage of every single transaction that flows through their card. And so they gain money on volume of dollars that flow through their card. They also obviously also make money based on fees for consumers that go over their credit limit or don't make payments, et cetera, et cetera. But for the most part, if you look at the business model of credit cards, they're just trying to break even on that. Their actuarial approach to issuing credit is mostly for them to simply break even, and really their profit center has to do with the fees that they're setting on the transactions. Okay. Another example is video game consoles. So I'm talking about PlayStation, Xbox, Nintendo. So what we have here is a console that is acting as a standardized platform to bring together video game players and video game designers. Okay, so you have a video game designer who has a cool idea for a new game. You have video game players who want the entertainment value of that game. It is really expensive for video game designers to also have to build and issue, say, their own hardware to run the game on. And so instead, these consoles provide a standardized platform to connect these two groups of people by, again, charging fixed and variable fees, which can be positive or negative to both sides. In the video game console market, the equilibrium has been to sell video game consoles at a loss, which is effectively subsidizing their sale. It's not the same as a negative fee because video game players still pay a positive price to purchase the video game console, but they pay much less than the cost of producing that console. That the console manufacturers sell their game consoles at a loss when you take into account all the design and manufacturing, etc., that goes into them. And then they charge a royalty fee to the video game designers. So what happens is that video game players likely end up paying a bit more for their video games because of these royalty fees on the back end that video game designers pay to the video game console companies in order to be on their console. So again, it's following a similar pattern where they are subsidizing and or giving away for free the platform to the masses, to the kind of the retail consumers, and then they are charging the back end, they're charging the designers, the suppliers, if you will, of the content, a fee in order to keep them in business, in order to make that business profitable. And there are newer examples like Facebook and Uber and Airbnb. Facebook, I'm thinking of them as a media company. So this is also, you also see this in newspapers, so that I could have given a newspaper example. Facebook is like a newspaper in a sense, in that they give away their product for free, and then they make money on advertising. The same way newspapers, kind of were just trying to break even on their printing costs of their physical newspapers, and then they make money via advertising. Uber and Airbnb similarly are connecting groups of disparate disparate consumers who want transportation or want lodging, and combining them with other groups of people who have extra space in their car or who have extra space in their house to provide for lodging. So these are all examples of two-sided markets. And we're going to propose today that ETFs are in fact using a two-sided market. Okay, side one is retail investors who are providing the asset, and side two are securities borrowers who want those assets. Now, either side, again, can have a positive or negative fee, and that the ETF itself provides a standardized platform for the interaction between these two groups. So here's what I mean. So what we have is we have on the one side is we have all the investors over here who, these are, I imagine, to be retail investors who are wanting to invest their money in the stock market, and ideally they would like to in turn potentially lend their securities to stock borrowers, but making these individual connections is very, very hard. So instead what we have is an ETF that can stand in between them to provide this standardized platform. So this ETF might be, say, a tech sector ETF or an automotive ETF or a green energy ETF. And investors who want to invest in those stocks, they might not choose all the stocks in the ETF, but it's close enough that they're willing to standardize on that platform. Okay? And then the ETF aggregates the assets together to make them more attractive to stock borrowers, who then in turn want to borrow and provide lending revenue back to the ETF. And the ETF can in turn charge a very, very low expense ratio and provide good liquidity to these investors. Now, why should ETF investors care? Well, I'll let you read the comic. The reason why is down here at the bottom, right? That if you're not paying for it, you're not the customer, you're the product being sold, right? So as an ETF investor, you are not really the same as a mutual fund investor. If you're a mutual fund investor, it's fee for service. If you are an ETF investor, you are more the product being sold, and they're making most of their money from the securities lenders, not from you, or at least a substantial amount. So the implications, as I just said, is that you as an ETF investor it's not just another source of revenue. Securities lending is not just another source of revenue. It affects who the actual customer is in the interaction, in the transaction. And their incentive, ETF's incentive, is to maximize lending. Is this a problem? I don't know. That's not really our research question today. And really we can't answer that because we don't have enough information. Because of point 3. While securities lending is not exactly hidden, it's not really transparent either. We need more here to fully understand what's going on. So here's what we find. What we find is using the rigorous identification of the Rocher-Tirole paper, we show that ETFs are in fact operating in a two-sided market. That what we show is that the ratio between the lending revenue and the expense ratio is driving growth. That's what their necessary and sufficient test for a two-sided market is. Okay, so ETFs pass that test, as it will provide evidence of that. Secondly, ETFs are making a significant amount of money on securities lending. Using very basic conservative assumptions, they're making at least 23 to 28 basis points, which is about the same as their expense ratio. And under more aggressive assumptions, and when I say aggressive, I really just mean if they're optimizing, right? If they're actually working to optimize their securities lending practice, they could be making a way more than that, right? Up to double, triple, quadruple that. 55 to 114 basis points per year if they are actually working to maximize that part of their business, which we would expect them to do. They have every incentive to do so. And we show that ETFs respond to those incentives. When there is less transparency around the index they're following, we find that they are able to make more lending revenue. And that's just what we would expect because those are the incentives that are in place. So let's talk a little bit about what exchange-traded funds are here. I'm going to try to keep this short to keep us on track with time. But exchange-traded funds are really structured the same way as mutual funds are. They're 1940 Act funds. We're going to be talking mostly about physically replicated ETFs, which means they physically hold equities. We're going to be looking at North American equity ETFs. We're not going to be talking about synthetic ETFs. Synthetic ETFs can hold commodities or derivatives or other things like that. An important factor here is the creation redemption mechanism. Again, I'm not going to go into this in detail, but what this means is that ETFs are able to buy stocks through in-kind exchanges with agents that are called authorized participants, typically large Wall Street banks or brokers or something like that. So they provide a basket of stocks that they will exchange for a certain number of shares of the ETF that these authorized participants can make that exchange, and this generates an arbitrage between the ETF and the NAV of the ETF. Okay? Anytime they get out of sync with each other, authorized participants, and really anyone else, can arbitrage that. They can buy the cheap one and sell the expensive one to bring them back together. And effectively what this means is that ETFs can trade very efficiently because this in-kind exchange is not taxable. They can also minimize their transaction costs because they're basically outsourcing the transaction cost to these authorized participants in exchange for this automatic arbitrage between the ETF and its NAV. So they are not really in the business of buying or selling securities at all. They've outsourced that to the market. Now, ETFs are mostly, as we talked about, a passive investment which tracks an index, but there is some flexibility. Some of them have proprietary custom indexes, and we're going to exploit that later to show that they follow those incentives when they have more flexibility. And ETFs do have tracking error. It's typically called tracking difference, and it's the difference between the ETF and its index. What is securities lending? We're saying that ETFs are making money through securities lending. Really, lending is a misnomer. Okay? Lending, in this sense, is actually a temporary transfer of securities from the owner-lender, in this case the ETF, to the borrower, who's usually a short seller. Okay? The borrower keeps the rights to vote, dividends, etc. We're not really going to talk about that today. But the lender is still exposed to the market movements, right? They've not lost their economic exposure because the agreements are short-term and require the return of those securities. The loan is fully collateralized. Actually, it's over-collateralized, usually at 102%, usually with cash, which is invested at the risk-free rate. And then the price to borrow is based on the rebate owed to the borrower on the interest earned from that collateral. Okay, so you can imagine a zero price to borrow means that all of the interest earned on the collateral is returned to the borrower at the end of the transaction. That means there was a zero cost transaction. So they gave the cash was invested at the risk-free rate. At the end of the borrowing period, the cash is returned and all the interest is returned. It's as if the borrower invested that cash in treasuries themselves. Okay, so that's a zero rebate rate. If something less than that is returned, that means that the owner was getting some benefit from that stock. And price to borrow can also be, these rebate rates can also be negative, in which case not only would they keep all of the risk-free rate, but they might get even more money from the borrower as well to top them up because of additional risk or additional demand for that security. These are typically overnight, but automatically renewed at the end of each day, and then they can be recalled at any time. This is called recall risk, that lenders can demand securities at any time. The market is intermediated, there are agents, and it's done over the counter, so there are search costs involved. There's a big literature on that. Lending agents typically take a 10 to 20% of the lending fee. Okay? And as I said before, most commonly this is for short selling, though that doesn't necessarily have to be a directional bet. All right, so the first necessary condition for a two-sided market to be in place is increasing returns to scale, which are actually referred to in Roche and Terrell as positive network externalities. Okay, now for mutual funds, we really don't see this. In fact, there's a long literature saying that mutual funds actually have decreasing returns to scale, right? So we see this at the fund level in 2004, and we see it at the industry level in 2012 and 2015, both theoretically and empirically. And this is natural, right? We would expect that. Bigger funds have higher transaction costs because they have bigger price impact when they're trying to establish or get out of their positions. And the bigger the fund is, the more ideas and bigger ideas they need to continue generating alpha. We don't see this with exchange-traded funds. With exchange-traded funds, bigger size means lower transaction costs, not higher, because of their creation-redemption mechanism. They trade like a stock. The bigger they are, the more liquid they are. The bigger they are, the lower tracking they are because the arbitrage is easier. Okay, the liquidity of the arbitrage mechanism means that they track their index much tighter, and so that is also a increasing return to scale. And they don't have any alpha. They don't have to worry about that. The closer they tighten their index, the better they are. Therefore, ETFs have increasing return to scale. Another necessary condition is that you need two sides of the market. We've already talked about that, but let's also show, I want to show this to make sure you see that really that this retail story is believable. Because side one, what we're saying is that they are aggregating together retail investors. And that's what this plot shows, right? That what we see is that the number of, the red line here is what I call pass-through retail holdings through ETFs. So what this means is take a single ETF, and I'm going to compute its institutional ownership, and take 1 minus that. That's the retail ownership of the ETF. And then I'm going to multiply that by the holdings to find out what percentage of its holdings are held by retail investors by way of ETFs. And that's what this line represents here. So imagine an ETF held 100 shares of Microsoft. If that ETF is 60% retail held, then I'm going to allocate those 60 shares as, quote, retail shares held via ETFs. For reference, here this blue line is the standard institutional ownership line as we saw in Gompers and Metric 2001. As you can see, in most recent times, it's actually flattened out as we've seen a continued rise in ETF holdings by retail investors, although the ETFs here are on the right-hand axis. So really what we're seeing here is that 5% of the overall market is held by retail investors by way of ETFs, but this is pretty substantial growth considering not long ago it was at 0%. Okay? The other side of this transaction is stock borrowers. So stock borrowers prefer large beneficial owners and passive investors. We see this from Engelberg, Reed, and Ringenberg, who show that short selling risk is very real. And so borrowers are willing to maybe even, they don't say this, but I'm arguing, maybe even pay a premium, as we see in Hu, Pan, and Wang, who show that there is market power in the repo market, okay, which is kind of the flip side of lending fees. So when you have a large passive investor who has a large amount of stock, they do have some pricing power. Not unlimited, obviously, but they have some. So this is an important part of the other side of the market. So is lending profitable? So this is a plot of the average lending fees for the S&P 500. This is not a story just about small, hard-to-borrow stocks that are impossible to find, right? What we see here is that the S&P 500 has averaged about 40 basis points. If you look at this is 40 basis points. This is the average of the S&P 500, and whether it's equal weighted is the red, value weighted is the blue. So let's just stick with value weighted, right? So value weighted average is about 40 basis points, but the expense ratio for those ETFs is what? It's about 7 basis points. So these ETFs can charge investors 7 basis points, but they can turn around and lend the entire S&P 500 for another 40 basis points to make 47 basis points per year on that investment, when all they have to do is track the S&P 500 with some of the most liquid ETFs out there. I would say that's pretty lucrative. So here's our data. Our securities lending data comes from Market, which is formerly Data Explorers. It contains all U.S. equities from 2003 to 2012. We're going to start actually in 2009 because of we wanted to use daily data. That actually is being driven by our ETF data, not this data. It covers 85% of the market. There's some duplicates in there that we take care of. And then we have this mechanism whereby we have to infer what the rebate rates are. So what turns out in this data that we have, the rebate rate is only there about 30% of the time. Okay? So what we do is we're going to use the daily cost to borrow score, which is a binning, 1 to 10 bin ranking provided by Market. It's not deciles. You'll see that they're not, if you know this data, you know this already. But these are not in deciles, but they do provide information about the cost to borrow a stock. And these are created by Market. We're going to use that to infer what the rebate rates are. I'm going to talk about that on the next slide. We also have detailed share data about shares demanded and shares supplied, as well as the utilization rate, which we can compute from that. Right? It's kind of a measure of how tight the market is in terms of supply and demand. So here's what we're going to do. We're going to combine the lending fee that we do have across all stocks within the same DCBS per month. So what we're going to try to do is get a distribution by DCBS month of what the lending fees are. And then we're going to compute some statistics. 5th, 50th, and 95th percentile, as well as the mean on those bins. And we're going to merge those back in daily with the DCBS assignments for each stock to get an approximation of what that fee is. And then what we do is we go back and we calibrate it with data where we do have lending fees, both within this data set. We also got some data from Interactive Brokers of actual lending fees that they paid over a much shorter time period, and did some regressions and found that the R squared was something like 98% and the coefficient was 1.002. So we feel very confident that this is a very good estimation. And here's some summary statistics to kind of prove that. So these are the DCBS bins over here. Anyone who's seen this data knows that this is what I mean by they're not deciles. They're very skewed. Most of the observations are in DCBS 1, and then it goes down from there to be much less and less. It's very correlated with market cap. This DCBS 1 is the biggest firms, the most liquid. They're the lowest volatility. They have the narrowest spreads, and they're also the cheapest to borrow, as you would expect. Okay. These numbers are a little bit higher than I think the 22 or 25 basis points that you've seen earlier in the literature, because there has been kind of a secular shift in the market where things are more expensive since the financial crisis. Okay. So now we're also going to use ETF Holdings Data. Most ETFs do provide daily holdings data on their website, we get this ETF Holdings Data from Morningstar. Morningstar, as far as we can tell, has basically just taken this from their websites and categorized it. They've added a little bit to it. We have not only the CUSIP shares and the weight, but we also have category, which Morningstar is adding their sector style information to this. We also have the total net assets of the ETF. This is where we have our cutoff, because prior to 2009, it's mostly monthly data and very sporadic daily. In 2009 is when we start seeing much more reliable daily data for ETFs. So we're going to start in 2009. We also have data about sector styles, and I told you before that we're using only U.S. equities. And then we're also going to actually go out and hand collect the securities lending revenue that is rebated to ETF investors from ETFs by gathering their annual and semi-annual reports only in 2012. This is a much smaller sample, but it's kind of a test because ETFs do provide some information about securities lending data, so we wanted to make sure we were interacting with that. So what are our assumptions about ETF lending behavior? As I've said, there's not a lot of transparency around this. We don't know exactly how or why they lend, so we have to make some assumptions. Our base assumption, our kind of conservative assumption that we run through the paper, is what we call util, which is using the utilization ratio. All shares are lent out in proportion to their utilization ratio. This is a very passive approach, right? This is assuming that the ETFs are lending very passively. They're providing their portfolios to be lent, but then not really paying attention. Okay, so this is kind of, in a sense, a bare minimum of what we would expect them to get. The opt scenario is where they are paying attention. They're only lending out their most profitable holdings up to this 33% limit, which is kind of the obvious statutory limit given by the SEC. Now, depending on your interpretation, there has been some clarification later that they actually can lend up to 50%. So we do that for our max assumption. In practical terms, the difference between these two is relatively small. They give similar numbers. So we're keeping them distinct so you can see some difference, but there's not a huge difference between them, as you can see in the paper. I'm only going to focus today on the opt assumption because it's kind of the middle of the road, and without pressing too far on on optimization. And we think that this is reasonable. This is from a Vanguard white paper. Vanguard has said that they have designed their securities lending program to capture the scarcity premium found in many hard-to-borrow securities. So we expect that they are, in fact, lending out their most profitable securities in order to maximize their securities lending revenue. Now, we have several charts like this in the paper. I'm only going to go through one of these for brevity. But what this is showing is sort of a spectrum of assumptions in a single grid. So this is what these percentages are. These are percentages of the expense ratio of how much ETFs are making in securities lending. So, for instance, in this upper left-hand corner, using the lowest lending fees, so assuming the lending fees are in the 5th percentile of our DCBS assumptions, the average that they're making is 50% of the expense ratio. They're making at least half the expense ratio if we may take this conservative assumption. Using a little bit more middle-of-the-road assumptions about lending fees, on average, they're making between 115% and 144%. If we go down here to the median, right? So this is the median ETF. Okay, so this is the median of the distribution of ETFs. It's somewhere between 82% and 107%. So this right here is kind of bracketing things for us in terms of they're making somewhere between, say, 82% and 144% on average of their expense ratio. So they're at least matching it. But then we can also see down here that if they're being more aggressive, for instance, if they're getting better pricing, that's what this column represents, right? If these guys can get better pricing for this, they can make more money, right? If they're getting more aggressive pricing, maybe they're pushing some market power, they can do better. Or if they're just holding more lucrative stocks, that's a little bit of what this means, right? That they're in the 75th to 95th percentile of the distribution. They're holding stocks that just have higher lending fees. They can also make this. But you can see that on the higher end, they're making way more, 2, 3, 4, up to 6 or 7 times their expense ratio in securities lending revenue. And this, again, is using the opt assumption, right? So they might be making more of this if they're maximizing. This is assuming they're only going up to 33% of their portfolio. So as I said, we want to compare gross versus net revenue. And we really don't know this, but we try to infer Because what we're doing is we're looking at gross revenues. We can only see the total amount that they're making in revenues. We don't have anything about expenses. So we're trying to compare that to what the ETFs say that they are rebating. Okay, and so what we did is we gathered for 494 ETFs during 2012, we gathered all their annual and semi-annual reports on which they report their securities lending revenue. This is just ranked by terciles. The first tercile we can perhaps discard. These are going to be the smallest ETFs. You can call this an incubation bias if you like, but these are smallish ETFs. This is only about $11 million right here, so they're not that big. Really, to be viable, we got to look at these higher two terciles, and they give us a much more consistent result over here, which is that in general, it seems that they are returning about 30% of the revenue that we estimate to investors. So they're keeping about 70% of it, and that is being used to either pay the agent lenders, or they're keeping it for themselves or other expenses for their programs. And then about 30% of it is getting rebated to investors. Okay, so what does this mean? So this is our Roche and Tirole test. I really probably should change the title on this because this is no longer more on fee ratios. This is an older version of this presentation. This is the Roche and Tirole test. What we did here is we really just compared the three different firms. This is effectively the same as doing a matched sample. A matched sample is going to be really hard to do for reasons I won't go into, but this is basically the same because iShares, which is owned by BlackRock, State Street, and Vanguard account for about 90% of the physically replicated U.S. equity market. And they all compete with each other in pretty much every aspect. All of them have an SP 500 fund, all of them have a value fund, all of them have a growth fund, they all have sector funds, they all have style funds. And they're not going to compete with themselves. They're not going to have more than one fund doing exactly the same thing. So this really is kind of a matched sample, if you want to think about it that way. And so what we find here is that when the ratio between these two change, right, the ratio between the lending revenue shared and the expense ratio shifts, that in turn affects the growth rate. So what we see is that for these two, for iShares and State Street, okay, they have a relatively high percentage of revenue share. This is where we get the 30% on the previous page, because the 30%, remember, combines all these guys. Okay, so on average, iShares and State Street are actually sharing a higher percent with their investors. That means they are keeping less, right? So the amount they're keeping for themselves is relatively low. But they're making more money on expense ratios, right? They're on average charging about 50 or 45 basis points. And they've got pretty substantial growth rates because the ETF industry as a whole is growing pretty well. Vanguard, on the other hand, is doing something totally different, right? They're only sharing about 2.8% of their securities lending revenue. And that means they're keeping upwards of 97% of it for themselves. But look at this. Their expense ratios are way less. They're half that of State Street and iShares. Okay? And what does that mean? Well, they're growing faster. Their growth rate is much higher than the other two. Now, all the growth rates are high because ETFs have very high growth rates. But you can see that Vanguard is growing at almost double the rate of iShares and quadruple or more the rate of State Street. Okay? So this is the Roche and Tirole test, 2006. This is their test of whether we have a two-sided market or not, so that we're not just using the eye of the beholder to say is this a two-sided market or not. We're actually using a test to show it. And here we see it graphically. I won't spend too much time on this, but what we see here is that this is a market share chart, basically, that Vanguard is grabbing market share. They're growing, and they're now number 2 on the list behind iShares, which is number 1, and State Street is now number 3. In the past, back here, they had been number 2, and right here, when Vanguard had been number 3 in this place. And you can see the others kind of floated along here, kind of at about 10% of the market for a while. Why does this matter? So we're coming to the end here. The reason why this matters is because if you are an ETF investor, you are not the customer. You matter, absolutely you matter, right? Because ETFs can't do anything if they don't have assets. But what we see that they're doing is that the lending fees on the stocks are positively correlated with the delta between the ETF and the index. This is basically, this is like the tracking difference, right? This is the difference between the ETF and the index. That delta gets larger when lending fees are more lucrative, right? That they're willing to give up some tracking difference in order to make more in lending fees. Okay, and this is robust to all sorts of different controls. We've got clustered standard errors, various time dummies, and all sorts of controls for liquidity, which is the primary factor, as well as idiosyncratic volatility and clusters, as I said. So let's conclude. What we're arguing is that ETFs operate more like Facebook or Uber or any of these other kind of new technology firms that are also operating in a two-sided market, right? They are not operating in a traditional fee-for-service model. This creates different incentives to which they respond. And the main thing here is this requires different models for thinking about the incentives in ETFs. We can't use principal agent models anymore. And really what we need from an empirical perspective is we need more transparency. We need to understand more of what's going on. We have spent a lot of time trying to estimate what these ETFs are making in terms of revenues because we don't know. They claim they're returning lots of profits from securities lending to their investors, but we can't know that for sure because we don't know anything about their revenues and we don't know anything about their expenses. So we effectively have to take their word for it that when they say they're returning all the profits, they actually are, because that's not auditable even by the most sophisticated investor. In fact, Vanguard, who is the one that we were quoting earlier, is saying that they think the expense ratios can go to zero or even be negative, famously rebates what they claim to be 100% of securities lending revenues to their investors. So a surface reading of that would indicate that Vanguard is going to pay their investors to invest in them and then give 100% of the profits from securities lending to their investors. I would argue that that's impossible for them to do that and stay in business. So clearly there's something else going on, and we don't have full view into what that is or how it's working exactly. So thank you very much.